on the financials. You heard Ritu, the RBI has cautioned pretty vocally that the asset quality is likely to see a significant deterioration once the moratorium ends. So keeping that in mind, how would you approach the financials now?
Good morning, Rima. Thanks for having me. See, the financial services may still have near-term challenges given post-moratorium period has just started since September. Challenges do exist related to asset quality and disbursement growth, and banks are still relatively cautious speaking. Fundraising exercise has been resorted to many NBFCs, including banks in the recent past, to shore up their capital in this tough environment. Now, pandemic-induced pain on asset quality is yet to show up in gross NPA, to our mind. I mean, larger conservative banks and NBFCs have done front loading of provisions and guarding against any potential risks in post-moratorium period. We will still have a better handle on the credit costs in the December quarter, which is the first quarter post-moratorium period, and whether borrowers make payments or not for a few months post-moratorium period. So overall, we are currently selective to invest in the sector. However, what we would prefer in the current context is those where there is access to capital and quality of book is secure. Conservative private banks and NBFCs have upfronted provisions. Within NBFCs, we would prefer secure lending companies like housing finance with low exposure to builder loan, or microfinance companies despite being unsecured and are at risk. But given that their target market is rural lending or agriculture, which are an essential category, selective opportunities exist in microfinance space as well. So conservative NBFCs who have upfronted provisioning, private banks are the ones to look out for.
Okay. By the way, that's an extension on the travel ban to and from UK. Airlines flying in and out, both not allowed till the 7th. Now, earlier the ban was till the 31st. It was widely anticipated that it will be extended, and that extension has come through. Dhiraj, good morning. Thank you for joining in. And first of all, season's greetings to you. Wish you a very, very happy new year in advance. I take your point on, some of the better managed, perhaps micro lenders. But coming back to the big banks, this entire catch-up banking rally has been based on the premise that the market got too worried about COVID-related NPA stress and that everything's kind of, pretty much factored in the price. So would you expect a correction on the bigger names, the bigger lenders, be it the ICICI Bank or the HDFC Bank, Axis, all of them, the big ones?
It's quite possible because market had seen some kind of a rally in anticipation of a very faster economic recovery. And if the economic recovery becomes more broad-based and spread out across many small businesses as well, because it's the NPA is not just confined to the corporate lending part. It is also got extended to the more secure retail lending part. So we'll come to know only in the December quarter how the gross NPA trends have been. But yes, these are larger banks have done upfronting of provisioning ahead of time. So we might expect that the NPA severity will not be as it was anticipated. So these stocks have rallied. But I think now there is a time when these stocks will consolidate and see whether the actual results are exactly panning out. The gross NPA trends are not as severe as such. So yes, we might appear consolidation till the time the results are out and actual gross NPA trends post-moratorium period gets reflected in the financial numbers.
Dhiraj, this specialty chemicals is a theme that you've been recommending, and you yourself are invested in it on this whole China Plus One, strategy. The question is that stocks have already risen a fair bit, more than doubled. From here on in 2021, do you still see upside, or are the stock prices capturing in all the good news?
So, Rima, these businesses are more structural and sustainable. What had happened to pharma 20 years back is going to get reflected in specialty chemicals because ultimately the niche chemistry skills remains the same. So this is another area where we believe we have invested because of the continuous business shift from China due to pollution control norms or expected China Plus One strategy to have India as an alternate supply base or source. Huge amount of capital expenditure is happening in this specialty chemical space, which is an indicator of growth prospects of specialty chemical spectrum. Besides, specialty chemicals are the building blocks for pharma, personal care, like flavors and fragrances and agrochemicals that are in the essential and sustainable growth category. So while they may have discounted and some valuation re-rating has happened, if you believe that the business is structural, this is one area of business which can give more compounded returns, more sustainable returns in times to come with valuation predating as the growth pans out, because the size of the market opportunity is fairly big, like pharma space. So while despite the run-up, there is a possibility where the returns may be modest in the near term, but going forward, we are buying businesses for 5 or 10 years outlook, given the fact that the market size of opportunity is fairly big for specialty chemical space.
Okay, got that. So, by the way, just to prize our viewers, if we talk about Roha Asset Managers' overall view on the market, they like infrastructure, telecom, healthcare, and auto. And I think Dhiraj and his team are also fairly positive on cement. Also metals, despite the big rally that we've already seen in the sector. Interestingly, there's a cautious view coming in on technology. So, Dhiraj, since we're a little short on time, sum it up for us. And if you crystal ball gaze into 2021, what do you think will be the biggest theme? What's the big money-making idea for next year?
I think the biggest themes are a lot of things happening as far as globally when we talk about anti-China sentiment, which results in China plus one strategy. You can't replace China globally. But I think the outsourcing from India will continue to gain momentum, not only from the traditional sectors like IT or pharma, but it will spread out into APIs, chemicals, technology, home furnishing, floor tiles to garments, autos, precision engineering products. The other thing that we like as a theme is the import substitution, which is likely to play out well over the next many years because of the production-linked incentive scheme which has been offered. We all know it's about close to 1.4 to 1.5 lakh crore, and also raising of anti-dumping duty. This may benefit sectors such as electronics, medical devices, mobile phone manufacturing, metals, and even defense. And the third big theme obviously is going to be digital wave, which is already accelerated by many years due to COVID environment and can benefit technology service and platform providers, e-commerce companies across various verticals in retail, like online retail, fintech lending, and insurance. So this will drive greater consumption of demand, including some of the new areas like gadgets and gaming. I think there are many new things which are emerging where many of the businesses can grow from the way the traditional businesses have been working so far.